Casey Quinn, who has built a $120 million portfolio of real estate in a matter of 5 years.
BRRRR model investing is simply a way to get into space using very little of your own capital. Literally what it stands for is buy, renovate, rent, refinance, repeat the process over and over again. It is incredibly lucrative if you pay the government taxes to keep more real estate and do the tax benefits of it. I was a CPA for 10 years, public accounting, sick of traveling, took a local CFO job at a real estate company, and that was my introduction into BRRRR model investing, real estate in general. I lasted about 10 months there. The owner and I didn't get along. I didn't believe in how he treated people, different things like that. And so that was when I decided I was done working for anybody else for the rest of my life.
Hello everyone, and welcome to another episode of the Jack Boss Show, where we talk about all things real estate, finance, entrepreneurship. And today we're going to do a deep dive into the BRRRR model with my guest, Casey Quinn, who has built a $120 million portfolio of real estate in a matter of 5 years using that exact model. So Casey, how are you doing today?
Man, I'm good, Jack. How you doing?
I'm doing great.
Good.
So let's jump right in, and we're doing typically like the introduction, this kind of stuff a little later. Just people don't want to hear that thing. I mean, they want to hear that. They want to know who you are, but they want to know what are we talking about. So let's jump right into that and tell me, let's jump in. What is the BRRRR model?
Yeah, so BRRRR model investing is really a value add play in the real estate investment space where you're keeping real estate long-term, right? And the goal that I tell everybody is to build wealth. I think there's a lot of misnomers out there that people talk about BRRRR model investing and keeping real estate and building passive cash flow through real estate investment, right? And I tell everybody, okay, cool, maybe one day down the line when we have a lot less debt on the properties and inflation happens and rent continues to rise, right? BRRRR model investing is simply a way to get into space using very little of your own capital. And so literally what it stands for is buy, renovate, rent, refinance, repeat the process over and over again, right? And so what that really entails is borrowing short-term capital to come in, buy a property under market value, then add value to it through renovation, ideally a lot more than the money you're putting in to renovate it, rent the property to a tenant, and then go get it financed and have the tenant pay your mortgage indefinitely, right? And so people think, oh, passive cash flow. I always tell people, if you're putting debt on it and you're doing BRRRR, you don't have a ton of cash flow. The moment a furnace breaks or that roof that you didn't prepare for breaks down, right? All of that capital is gone. One big CapEx after you refinanced it, right? All of a sudden, all the money over the last 4 or 5 years is completely gone in order for that update, right? So I really teach and I tell people it's more about the long-term wealth and the tax benefits you get of keeping real estate, particularly now, right? And, I know we're not probably going to go into this a ton today, but the big, beautiful bill that was passed with cost segregation and 100% bonus depreciation that came back this year, it is incredibly lucrative if you pay the government taxes to keep more real estate and do the tax benefits of it. And when you don't have a lot of money to buy real estate, BRRRR model investing is the perfect way to go get the real estate, get the tax benefits, scale your wealth, and take advantage of the tax with the government. So that's in a nutshell what I would really describe as what BRRRR model investing is and how we were able to successfully do it a lot of times to build a significant portfolio.
All right, so let's dig into that a little bit more here. So there's a lot to unpack here. So the first of all is, what asset class have you usually been using that with? The single family, multifamily, commercial? I mean, BRRRR can in a way be used and done in multiple different asset classes.
Yeah, I think traditionally they consider BRRRR kind of like the single family residential. I consider it more. It's really when you're buying something under market value, adding value to it, and then trying to stabilize it on the back end, right? So you can do it in a lot of asset classes. For us specifically, where we kind of cut our teeth was in at first single families, and I include in single families duplexes, triplexes, and even fourplexes. In my opinion, is really single family. Happy to get into why I believe that. It's really about how you value the property and how you exit the property and who you can exit it to. But really, you can do it multifamily, in 5+ as well. And so for us, we've probably done about 350 single-family homes that we have in our portfolio. We have about 950 total units. And so you can kind of do the math, right? Our largest deal is a 98-unit value-add BRRRR model deal that we've done. We're still actively doing that one. And we've done, everything from 40 units, on down. Outside of that one, we have a 60-unit. But predominantly where we got started was in the single family space, right? I bought a $40,000 home. Next one was a $52,000 home. And we took it from there. But really, it's a really good avenue to get started in if you're not a significant real estate investor yet. You don't have a ton of capital, and you're really trying to build some wealth and save some taxes on your W-2s or build a rental portfolio. It's the easiest way to do it. But single family homes is how we did it, and that's what I recommend others to do it in.
Okay. And where do you live?
I live in Pittsburgh.
All right. And there's $40,000 houses there?
Not anymore. But yeah, I mean, we were still considered. Pittsburgh is a very investable city. It's one of the most livable cities. I think even 2024 it was ranked the most livable city. And then our average median price, I believe, it may have shifted in the last couple months, but as of Q1 was the lowest average median price in the country. I think Alabama is taking the lead on us. But we're right there, especially Pittsburgh inside of PA, because Philadelphia is a lot more expensive than Pittsburgh is, right? But certainly very much more successful when you think about the sale price, the rental amount, particularly now with where rates are, right? You have to really, a lot of people call it the 1% rule, if you're familiar with the 1% rule, which is essentially, what your rent is compared to what you're paying for it ultimately, and making sure that the rent is 1% of what you're paying it for, right? That's kind of a little bit of a barometer.
Let's go into that in a second. I made a note. I want to get into the 1% rule, but to see if that's even applicable today, still with the current cost structure of everything. But so just quick summary. So BRRRR essentially means you buy a property under value, you take a loan on it, put very little money down, you remodel that property. Then you refinance the property at a higher rate, and you rent the property and refinance it ideally as an investment property, and then you just hold on to that thing for long term, and ideally you don't lose money in the process. That's so, ideally, right? And then you do it again and again and again and again. You mentioned some very important things at the very, very beginning in your opening sentences, and that is that this is not a cash flow strategy except for exceptional cases. I mean, of course, if you get like this super mega bargain and you can rent it for $3,000 and you only paid $100,000 for it, great, it cash flows. But this is not that's not a cash flow strategy. It's a wealth creation strategy.
For sure.
And you dive into the difference between those two just from an understanding point of view. And when do you estimate, will you over time get to the cash flow portion? Because at the end of the day, wealth is great, but cash pays the bills.
Yeah, for sure. Right. So the biggest difference that I would tell you is when you're BRRRR model investing, you're not putting your own money down or you're trying to get out of it. So you're leveraging debt, right? So you have a big mortgage payment, which includes interest and principal pay down. Okay. And so basically when you go to BRRRR model invest, 1.2 debt service coverage ratio is a fundamental number that everybody in the world should know if they ever want to get into real estate investing. What is my debt service coverage? Most banks require at least a 1.2. When the economy gets bad, it's more of like a 1.3. Some lenders are getting looser down to 1.1. And then you have some institutional these days even saying at a 1.0. What that really means is how much money are you making above and beyond whatever that payment is? And so it's your net operating income, right, divided by whatever your mortgage payment is.
Are they going down to 1.0 for you guys, or is that for the average person out there?
It's not really for me or the average person out there. What it's for is some institutions just get, they'll do a short-term loan or they'll do like a 3-year interest-only loan where they're really only requiring a 1 debt service coverage ratio. A lot of times they're loan to value, right? LTV is what it's called, which is the total borrowed versus what the property is worth, has to be significantly lower so they feel protected in the deal, right?
Yeah, because again, the DSCR is like basically debt service coverage ratio. It means that if you have to pay $1,000 a month in mortgage, then that rent amount minus expenses ideally should be at least $1,000. That would be 1-to-1. That's a one debt service coverage ratio. If that is $1,100, it's 1.1. If it's $1,200, it's 1.2. If it's $1,300, so going down to 1.1 or even 1.0 really doesn't leave any space for anything going wrong. If like something major going wrong, you have to come out of pocket with that, and the bank needs to be comfortable with you having that ability. And that's why I'm asking, like with you guys with 900 units, they might be more comfortable with than with somebody who does it for the first time.
I will caveat that. I will tell you, I don't feel comfortable doing that, right? So my background, I'm a CPA by trade. I know we didn't talk much about that, but I'm a numbers guy. I ran the company. I've scaled the business based on numbers. I've never done it. I refuse to ever go 1.1. And so there are institutions out there willing to do that. Certainly not banks. A bank, you cannot find a bank willing to do it. But there's some private capital where if they're trying to win the market, they've got aggressive capital they're trying to put on the streets. There are out there. I don't recommend it to any investor, particularly not
Yeah.
any non-institutional investor, right? If you're doing thousands of deals and you have capital, whatever, okay, maybe. But if you're me and and anybody
Yeah.
that has done less deals than us, then particularly like don't do it because it creates so much risk, right?
Mhm.
If you only had a 1-to-1, and so let's just say your monthly rent is 1,200, your net operating, well, let's just say your monthly rent's 2,000, your net operating income is 1,000, right? So you got to pay your maintenance and you got to pay your property management fees, you got to pay your taxes, you got to pay your insurance. You got to pay these things. And so let's say your net is 1,000 and your mortgage payment is 1,000 a month. Well, you have $0, right? Left. Well, what happens when the refrigerator blows at the same day that the HVAC unit blows? What do? You don't have any money. There's zero money, right? You're not making
Yeah.
any money. And so there's significant risk here. What happens if that single family home tenant decides they're not going to pay rent for the next 4 months? What happens then, right? And so that it just creates a significant amount of risk inside of that deal that I highly recommend that nobody does at a 1.0. The banks require
Unless you have a whole bunch of
1.2
money on the sidelines to cover that kind of things.
for
But
sure,
again,
right? And
that's
then that's
why,
a leverage game. You're playing a
yeah,
leverage.
that's where but if you're a beginning investor wanting to get into the BRRRR in the BRRRR system and you don't have a much of money on the sideline, then you are going to be happy if the lender only gives you the money if you have if there's enough buffer in there. Because if you get for every dollar you have to pay in mortgage, you get 1.4. Well, then you have a little bit on the side, and again, that should be used to put a bunch of that should first go into reserves on the sideline. Because again, when something happens, we had a thing. We had a little roof leak in one of our rental houses, and the roofer goes up there and he just breaks clean through the roof, and nothing happened. He didn't get hurt, but
Yeah.
now we have another new roof. It's a $10,000 roof. We're like, great. So that just wipes out my cash flow on that property for the next about year
Yeah,
because it's
that's
free and
right.
clear, and then
Yeah.
everything. I'm probably getting $800-900 a month in free cash flow on that property, but for the next year, that cash flow is wiped out. But I have to come out of the pocket with it. So that's why it's good. You don't want to have the cash flow be so tight that you can just only pay the mortgage and nothing else, because any eventuality has to come out of your pocket. Right,
Yeah.
great. So, but it's a great model if you have some reserves, and if you do it conservatively enough, and if your mortgage payment is low enough that this DSCR is high enough, then it's a great model. So you started with one deal, or you started with like your CPA, and now let's go into a little bit into your history. Like you're CPA and you're doing CPA stuff, I assume, and all of a sudden you get the idea of building a portfolio of 900 properties, or how did that happen?
Yeah, I don't know that I necessarily got the idea. I'll keep it nice and short for you, man, right? Like so basically I was a CPA for 10 years, public accounting, sick of traveling, took a local CFO job at a real estate company, and that was my introduction into BRRRR model investing, real estate in general. It was a very local, small company. They had about 500 units, give or take, had built it over 15 years, all single family residential. And I lasted about 10 months there. I came in, it was just a disaster in accounting. I don't even want to get into it, but I really cleaned it all up, fixed it all, hired a controller, and I really started to run the company. And long story short, the boss and I, the owner and I, didn't get along. I didn't believe in how he treated people, different things like that. And so, long story short, he actually fired me after about 10 months. And so that was when I decided I was done working for anybody else for the rest of my life. I asked my wife for 6 months to figure this out, to figure out how I can go be my own entrepreneur and be my own boss. And what I really did with it was I started doing bookkeeping. I went around a bunch of local agents and I said, "Hey, I'll do your bookkeeping." And now my business partner of over 6 years and a really close friend of mine at the time, I started doing his bookkeeping. And we looked at each other after about 2 weeks and was like, "Dude, I can do all of this. You go find deals." And the rest is history. We bought our first house May 21st of 2019. That was a BRRRR model deal. We bought it for $40,000. It was actually already occupied. We only put about 5 to 10 grand in it because it was already occupied, and we were able to get like a $75,000 value on the property. And so we went to the bank, cashed out, and we did it again, and we just started doing it as fast as we possibly could, managing our cost of capital really well, understanding the financial side of this business extremely well, which allowed us to scale to 950 units in about 5.5 years.
Right. And now um the question I have is, as you scale this, the typical word in the street is that any bank only gives you money for up to 5 or 10 deals. How did you overcome that to scale to 900 and something units? I mean, the multifamily side, the thing, but even you have like what 395 actual single families that you have, or
Yeah.
duplex or fourplexes. All of that falls under the residential area. So from a financing point of view, how did you scale to that number? Did you work with 30 different banks, or did you go to some private money lenders, or how does that work? And how does that affect also the rates that you're getting out there?
Yeah. It's a plethora of different answers to answer your question. Ultimately, what I would tell you is a myth, without a doubt, around financing up to 5 or 10 with a bank, right? I think that difference is really what I would tell you is that's for individuals when you're borrowing or buying properties in your own personal name. I don't recommend ever buying a rental in your own personal name. I recommend buying a rental in an LLC, particularly not a S Corp LLC. You should only use that for operations, but a traditional partnership LLC or a sole member LLC if you're by yourself. And then you can buy unlimited, right? Now you have certain thresholds that you'll hit with banks where, once you hit 5 grand, 5 million or 10 million, depending, right? The different bank thresholds levels, depending on if it's a local bank, a regional bank, a national bank, right? Very different. I highly recommend going to local and regional banks over national banks without a doubt. And they have different levels where, it's just a loan originator, then it's the chief credit officer, then it's the leadership team, then it's the board. And you really want to continue to leverage that, right? And you find really good relationships. At the end of the day, the bank is still people and it's still very relationship driven. And so it's really about building really strong, good relationships with the banks. To answer your second part of that question, kind of like how we did it was really, yeah, that we have, I think, 9 or 10 banks that we've always worked with. We shop it. And then we have credit unions. I would tell everybody out there, credit unions are incredible. They're a lot easier to work with, and they're really good pricing in terms of what you're trying to do. They're cheap to get the loans, and they love single family real estate investment. Most credit unions across the country love it, and there's a lot in your local area. A lot of them are localized. So we did, we probably have about 30 to 35 million with credit unions, probably about another 30 to 35 million with banks. And then we also, along our journey, we also diversified a little bit from a risk perspective and also still use some institutions. Right. I don't want to mention any names, but the Kiavis of the world, the Renovas of the world, right? Like, all of those guys. We do have some various strategic loans with those guys, 30-year fix, where we said, hey, look, just depending, let's diversify a little bit here and have some on the DSCR loan side as well, right? There's a ton of institutions out there now lending. It's just a lot more expensive to get that paper, but it is pretty easy.
Okay. Now, what interest rates are you getting charged these days on these things?
Oh man, I don't even know these days. My CFO handles most of it, but it's not fun every time I cringe. I think we're at the 7.25 range. Anywhere from 7 to 7.5 is generally where we've fallen over the last 6 to 12 months on our rates, which, if you go to the DSCR side, they fluctuate even more, right? Because they're moving a lot more with the bond markets than the banks do. And those fluctuate a ton. I think we have some deals up in the eights when when it's worst. I think they're also in the sevens ish right now. Um, right, and so we've gone as low as 4.25. That's the lowest rate we've ever been able to receive. Again, because the lowest rates possible are certainly when you buy it in your own personal name, right? Especially if you say you're going to live there. So all of this is traditional commercial mortgages that we have through an LLC. And so, those rates are generally about a point, half a point to a point higher, depending on who you're working with. But that's our rates right now. We're right in the sevens, and they've been relatively stabilized for us.
Okay. So again, for the audience to listen to, 7.5, this doesn't destroy your market. It just means you need to find deals that work in that space. Now you're in Pittsburgh.
Pittsburgh.
Is most of your properties in that kind of greater area, or or are you doing deals nationwide?
Yeah, so all of our deals, yes, all of our deals. We are in about 65 local communities across the city of Pittsburgh. We started in one and we've continued to grow localized in communities, right? And the reason we do that is because we love boots on the ground. I personally am a huge believer in having boots on the ground, right? People that can go to the property. I personally haven't been in a property I own in 3 years, but guess what? I can literally right now drive to every single one of them if I needed to for some reason. We have in-house property management, so we manage all of our own properties. And so, right, we have a full-blown 15-person staff maintenance division. Our leasing agents, our property managers. We've built that business. I was a big believer when I saw money going out the door that we need to keep the money. So how do we create an organization, a business, if you will, to service all of the money that we're spending in the real estate? And so I highly encourage that if you can. Certainly, if you're in the middle of LA, you're not going to be able to do that, right? And right now, with rates where that, there's a lot of cities across the country that it's really not feasible. So what I would recommend if you're gonna invest and do BRRRR model investing nationwide, really focus on one or two areas, get to know the areas, get there, get your own eyes on things, and then get people you really know, like, and trust in those areas, and then really double down and triple down in those areas. Don't buy one in Detroit, one in Pittsburgh, one in Alabama, right? Like, don't spread yourself thin there where you have different property man, because then it creates asset management nightmares, if you will, right? So, but yeah, all of our properties in Pittsburgh, and I highly recommend localizing everywhere you can when you're doing the BRRRR model investment, because then you get to know the lenders, right? The local lenders. It's really important when you're BRRRRing to work with local lenders because a lot of banks don't like it. Your national banks, your PNCs, your Wells Fargos, most of all of your national banks won't even lend on it. So you got to kind of really engrave yourself in the locals or go institutional with the DSCR loans. But again, you're paying a lot more money and they're a lot harder to pencil.
Yep. Um, that makes sense. Now let's go to great advice here. So let's go to the 1% rule that I wanted to go back to.
Yeah.
Explain that to us. What does it mean? How does it apply to it? Where does it fit into all of this? How do you use it? Or do you use it? Or has it changed how you use it?
Yeah, I don't particularly, be honest with you, we haven't used it a ton. Again, I'm a CPA, so like I really like to get granular on the numbers. 1% rule is a different way to kind of value or look at if a deal is feasible. I would tell you that if you're going to use the 1% rule, certainly you can ChatGPT, Google it, right? It's like, what is it in theory? And then how can you apply it? What I would tell you is it is a very much a quick back of the napkin, can this deal pencil? Meaning, can I acquire the property, renovate it, have money into it, and then actually cash flow to where a bank is willing to fund you money on it, right? So the 1.0 DSCR that we talked about earlier, right? What the 1% rule is really telling you is 1% of the purchase price or 1% of your all-in cost, however you want to look at it, rent for the month is 1% of that, right? So said another way, if you can rent a property for 1,200 bucks and they're asking you $150,000 just to acquire the property, do the math, your 120,000 is 1% or reverse engineered. 1,200 a month is 1% 120,000, right? There's no way this thing's penciling to be a rental for you at $150,000 acquisition price. And so that's
the other way around. If you go into the market and you see they want $300,000 for a property, you're like, great, what are the rents in the area? And you see the rents are $2,000, it won't pencil because the $2,000 is less than 1%. If you see 100%. Rents are $4,000, okay, well, now let's talk. Now it's $1.33 per, like it's 1.33%. Rent per month is 1.33% off the purchase price. Because the thinking behind this is like, if I pay $300,000 for a house, I'm going to have a mortgage close to $300,000 because you don't want to put much money down at a 7% interest rate. Well, that's whatever that is. That's $2,100 in just interest.
Yeah.
Plus some principal, plus some maintenance, plus some property management. That's $3,000. So that's basically right. The $3,000 are out the door just for these kind of things. So as a fact, and if rents is less than that, you're basically most likely looking at a cash flow hole.
Yeah, and I look at it as we also kind of look at it like you're all in. And so to your exact point, right? Like I gave you just a random in my life. Beachview is a local community here in Pittsburgh, right? You're looking at anywhere from $1,000 for your low ends to $1,800 to $1,900 in your upper end, fully remodeled, 3 bedroom, 2 bath homes in Beachview, right? So if someone puts something on the market for 200 grand, to your exact point, literally walk away. There's no point in even having a conversation because 200 grand, your closing costs to get the deal, your debt financing costs, you probably have to do something to the property. And so there's no way that thing's going to ever pencil, right? Even at maximum rents. And so don't even waste a minute of your time on that specific deal, right? Now we back off. There's a listing for 100K. Okay, cool. That's going to pencil. Now you're doing math. How $100,000 purchase? I can rent it anywhere from 1,000, which would be 1%, to 1,800. Now we're looking at a value add opportunity, right? If I could buy it for 100 and I could put 40,000 into it and make it worth two, and I could rent it for 1,800, now I'm going to get $140,000, $50,000 loan, get completely out of it, and it still pencils enough that a bank is willing to give me the money. And now I'm going to do the deal.
And that's where the refinance comes in, because that's the value add. Like, again,
That's right.
perfect example, $100,000 purchase price. But if you can get some extra money to rehab it and make it worth $200,000 when you refinance, you can reasonably get 150 out. So you get all your cash out. Now you have zero money in the deal, and it still cash flows. And that obviously, even just a little bit, but that's obviously is the ideal situation.
Yeah, so I don't want to paint a picture where it's not possible today to do what I'm about to tell you. It's certainly more difficult across the country just because simply where the rates are at, right?
Right.
And so the maximum loan to value you can get because of the rates based on your debt service, they can't give you as much money. But for us, when the rates were really low, we started in 2019 and then COVID, we lasted, COVID came about a year later. Obviously, it was incredibly scary for everybody. Our real estate that we already acquired, everything else. But post-COVID, as you know, not the rates, but the country, real estate just skyrocketed across the country in values. Our business, right, is a little bit of luck in the game that we've built here, but our business is not happening now. But we were doing deals like we were making millions of dollars off of cash out refinances, right? Because we would buy a property for 60 grand. We would put 40,000 into it. It was worth 250,000. Renting for 2,000, we were able to go get 180, 190,000 out of one deal. And so we were cashing out 40, 50 grand, right? Cash out means it's not real income, it's just debt, right? Yeah. It's a mortgage. So we don't have to pay taxes on the mortgage. But the really cool thing was we didn't have to pay it back, obviously, because the tenant was paying our rent, which was paying our mortgage. And we had safety because we were at a 1.2 debt service coverage ratio. So if anything went wrong, we were building reserves and we were cash flowing into reserves on the property. So that 50 grand that we made on the cash out refinance, as we call it, was income to us. And so we used that money over and over to actually build a business, right? We built property management, we built a construction company, right? We paid for our bills that we had at home because it was my full-time job. And so it's really difficult to do that now, but there will be another time where nationally it will make sense, right? The real estate market goes in ebbs and flows, and there's still opportunities. I mean, I think in 2024, we bought 94 single family homes. I believe across all 94, we were right around break even on our cash out refinances, give or take. And so we had about half of those properties where we had to leave money in and half of those properties where we still actually made cash out on the refinance, right? And so obviously nowhere near and not paying the bills anymore by any means, right? It's why we've had other companies. We were wholesaling, fix and flipping, right? So I tell everybody, have active income if you're going to do this. Use this as wealth building right now because you're not really going to be able to cash out and pay bills and live off of cash out.
That's really the perfect transition. You like silver platter brought it up for me, which is really the final part of what I want to talk about. The second final part. I do want to talk about what's on your t-shirt, the Crewity, a little bit, because you have also added a new company as a bookkeeping and accounting company, which we just hired for our company. So you guys are doing our bookkeeping and accounting as of like literally this month. But before I want to do that let's talk me through your reasoning of the wealth building part of that, because I love what you guys are doing. One of my core things, and And Michelle, and actually my daughter, just very, very funny. I was actually in Philadelphia last weekend because she's currently, we're recording this in end of July 2025. She's currently at Wharton School of Business at a summer program for high school students. So she's not in
Okay.
college at
Okay.
Wharton, but she's doing a
Maybe soon.
competitive. She had to apply, and only a few people were taken. But at a Wharton finance program, and she texted me this morning like, I finally truly understand how compounding works. And I finally, it's like, I'm in love with it. I'm loving this. And it's like, great girl. Because if you truly understand compounding, like
Game
Albert
over.
Einstein
Yeah.
called compounding the eighth wonder of the world. And in a way, what you guys are doing plays in that it's that delayed compounding to me goes along with the word delayed gratification. Because
Yeah.
instead of taking money and just spending it, and by investing it and having it grow and having its earnings grow more and then grow more, and you're compounding that, you can over time exponentially grow your wealth. And then when you delay gratification down the road, you can live a life that nobody else can live. And you guys obviously have played into that because when you buy these birthing, you do a lot of effort. You have to find those deals. You have to get those deals. You have to rehab those deals. You have to put the work in. You have to refinance them. And then you own them and you don't even make cash flow on that? That sounds freaking unsexy.
Yes. Very
Except
unsexy.
for if you look at it 30 years down the road when all these houses are paid off.
Yes.
And rents are 3 times what they're today. So
Yes.
is that how you're wired? Or what brought you to that, and why, like, what person would be drawn to this? And explain like your reasoning for getting a BRRRR and building all these companies that cost money and that are essentially not making a profit for you.
Yeah, that's a great question, right? We could probably have a whole separate podcast on this to try to simplify it. But it's actually funny you say that about compounding, right? The very first, we raise private capital. We do hard money lending as well and invest in deals. And the very first question I ask potential investors with us is, do you need the cash return, the interest that you would earn on a monthly basis? And if you don't, we should have a conversation around compounding because you imagine doubling your money in 5, 6, or 7 years, depending on the rate that you get. That's amazing. Instead of taking the cash, right? A lot of people need a cash if you need a car payment, whatever, right? So it's a very fundamental question that everybody should be answering really in every dollar that they're getting in any investment that they have. So it's incredible that you brought it up and think about it, and that your daughter in high school is learning it, because I wish I learned it in high school. It's
Yeah,
incredible,
me too.
right? So to get to your question, right, along those exact same lines, like, yeah, it is absolutely the great delayed gratification, right? You're building a balance sheet. What I mean by that is you're building net wealth. And at the time, it's stuck in the real estate, right? It's stuck on paper, as they call it, and you can't get it out. And so it's challenging, right, as you're scaling, because where are you getting money to build the businesses? And so, you know, I think for me early on, I just didn't know any better. The company that I was at and had got fired from was building the real estate portfolio. And so I realized my skill set was I can really manage cost of capital, manage the finance side, manage accounting to take 2 loans on every single deal we do and condense the time as fast as possible, right, to maximize our return. And so I was just doing that, not realizing what I was really doing, which was building this huge nest egg of wealth and the value that that'll bring me long term that I might not have known yet, which was, guess who everybody wants to talk to compared to like driving the Rolls Royce down the street worth nothing, or me who doesn't have a Rolls Royce, but I've got 50 millions in wealth, right? Guess who wants to talk to me compared to you? The bank, right? The bankers. And so, and private investors and everybody else in terms of, right, who's safe, who knows what they're doing, because you have this safety net now forever. To your point, it's also compounding because you're paying off mortgage, so you're getting wealthier. Right now, not including inflation. Inflation never happened. Right now, I'm getting $63,000 wealthier every single month because my
Just by
tenants,
paying off the mortgages.
by paying the principal piece of the mortgage. Now that the mortgage payments are significantly higher, there's a lot of interest, especially on the newer properties we bought. But on that entire portfolio accumulation, I'm paying $63,000 in actual mortgages pay down. So if I sold something, right, I have more wealth. And so, yeah, but for me, the other benefit that I have is I actually do also live in Pittsburgh, and I was heads down for 3 years. And I didn't realize that there's this big whole world out there of all of these investors buying these cars, fixing and flipping and all of these things. And I'm like, I'm just stacking, right? I'm just stacking. My only goal was build portfolio. Because the other thing that I realized too is it creates a ton of transactional volume. What I mean by that is there's so many other ways to make money off of that specific real estate. And so let's continue to make more money off of these other businesses. So we created a construction company, then we started selling to other people. We created management, started managing for other people. We had a brokerage, started doing real estate deals for other people. Now we have a lending company. Now we lend to other people, all because we've created this wealth, right? And people want to give us money because we are safe to invest with. And so, I don't think that I realized all of it at the time. And I didn't have mentors and podcasts that I was listening to give me this education. But it is unbelievable to your point of compound interest or building net wealth and of the gratification. Stop spending and wasting money as much as you can today in order to have more of it later. To your point, it'll change the world for you. It changes absolutely everything. And that's what it's done for me. And now I have a significant amount of wealth built up. Now, the challenge obviously is how are you making enough cash to pay the bills when you're going to masterminds and you're doing different things, right? You don't want to be the guy there wearing the $4 t-shirt when everyone else in the room has the $800 t-shirt, not because you choose to, but because you can't afford it. And so,
Right.
I've evolved more in these other side businesses to say, hey, I want to start making more money, more cash flow. How do I do that? Because I don't want to take it from my wealth. I want to continue to build that. But there did come a point in time where, like, yeah, some of these things would be nice to have, right? I want to buy Starbucks every day. But I came from a job I got fired from. And so for me, it was, all right, we're living on nothing for 6 months. Let's
Yeah.
start racking and stacking, right? That was kind of the goal, but I
So
didn't
in
really.
essence, if we just take that business, and again, you just mentioned that this business spawned all the additional businesses because in order to run that, you've become really good at accounting. Now you have a bookkeeping and accounting firm. You've become really good at with money. So now you have a lending firm. You're really good in construction. Now you have a construction firm. All these are active additional businesses that came from that wasn't unplanned. But the gist of it, if somebody does that in a smaller volume, you're building wealth. You're not building cash flow. So you got to be aware. You got to be disciplined. You got to be patient because probably in the first 10 years of this, you're not paying your bills from these houses because you're just paying the mortgages and you're building up, as you said. I love that. And yet every mortgage payment pays a little bit of principal. If you add that up, boom, then there's the tax savings. We haven't talked about those yet, but I talked about that in another podcast. Even probably just like you get the cost segregation, the write-offs, all those things. So you're not paying taxes on this. You're a real estate professional. You can roll that over into other income, and now you might not even pay taxes on your W-2 income if you still have a W-2 income anymore. And so you have savings over there, and that's an income, additional income you have by not. If you don't give it to the government, but you get to keep it, that's extra income. But the point is, you can't count on doing that only if like there's another boost in appreciation. Could you borrow some of it out and use that?
Yep.
Or if there's interest rates drop and perhaps things went up, you can refinance, perhaps even without taking cash out, to just drop your payments, and now your cash flow goes up. Have you done any of these kind of things?
Yeah, that's what I was going to say. I wanted to make sure we touched on that too, because I think it's an important thing that if you're just going to have some patience, you don't have to have patience forever. What I mean by that is you can refinance the property down the line again once inflation occurs and you pay down some of the mortgage.
Right.
So for us right now, a lot of our properties that we bought in 2021, 2022, a lot of those this year, we're doing a ton of refinances. I literally last week closed on a $600,000 cash out refinance. And guess what? The property's still at a 1.2 DSCR, but we had paid down our mortgage so much the tenant had, plus inflation occurred over 3 or 4 years. And so we were able to say, hey, banks, we have this property. We only owe about 60% of what it's worth. Are you willing to give us 80% of what it's worth? We'll pay off the 60% that we have, and we're going to net out the 20% in real cash in our pockets. And so last week, we got a $600,000 check that went right into the business, right, to fund the operations and fund everything that we're doing because we were patient for 3 years. Now we still have 20% wealth on the property.
Or if you're a single person doing that would go straight into your bank account.
Absolutely. Yeah. It goes right. I mean, that's your income at the end of the
Yeah.
day, right? It goes right into your income. Now everything for us is going
Non-taxable income because it's a loan.
non-taxable because it's a loan. Absolutely.
Yeah.
Right.
Yeah.
And
We
so
have a similar
you got a lot
situation.
of
We have
people
a
that bought
nice,
properties 10 years ago that haven't done it. They only like, and so I coach a lot of people around like, well, let's look at your wealth. Let's look at your portfolio. You need money. Your business isn't doing well. Can we go get a couple million from your portfolio? Right. And a lot of people don't want to do that. And I say, why? It's the cheapest form of debt you could ever have because it's asset backed, right? You're paying, we just talked about it, 7%. Go try to find a business loan for 7%. Can't do it, you know?
yeah. And that's how, if you look at that, Elon Musk, when he bought Twitter, now X, basically that's what he did. He borrowed 42 billion against his 400 billion or whatever at the time,
Yeah.
250 billion. And in the meantime, his portfolio is his portfolio of shares for SpaceX and Tesla is worth 250 billion at a time. Now he didn't sell those. That's his real estate. He
Yeah.
owns that real estate. It just happens to be shares. That went to 400 billion. At the same time, his loan is at a 5% or something because it's secured. If the stock goes down a certain amount, they would have to sell it, and he would pay it off and so on, and he had less shares. But the point is, it's almost like it's the same thing. That's how the rich make money. And we have a similar situation. We have a multifamily property that we own, just Michelle and I own, and at the time it was an 80% loan to value, but then exactly that, inflation and rent raises got up and doubled the value of that multifamily property. And we're still we're at like a 35% loan to value on that thing. The only reason I don't want to refinance it is at 3.4%, and I would have to refinance into the 6% right now. But if we ever need access to a significant amount of cash, I could always do that. On that end, how old are you?
I'm 37.
All right, young puppy. So the congratulations. That's amazing what you have accomplished at a young age. How do you position yourself around the concept of certain assets are untouchable or not? Like I'm 55, so I'm starting to my mind shift. I mean, I was 37. I was not exactly like you. Now, am I 55? I was like, no, I got a whole ton of equity in my house. I'm not touching that because I don't sleep well at night if I touch that equity, even though I can get it out at 6% and I can probably put it out there at 12% and double my money, but I don't want to do it because I don't sleep well at night.
Yeah, I mean, I think everybody can have that. I don't think your opinion is wrong in terms of the safety net and the conservatism that you want to play inside of your wealth generating, inside of your life, with where you're at in your career, your life, and everything you have going on. For me, at least right now, what I just believe wholeheartedly is everything should be a database decision and nothing should be off the table.
And I
Right? If
love
there's
that.
a better database decision that you should make in any asset ever, you should make the best decision for that asset and for you. Now, to your point, you have conservative viewpoints around, well, it's just safety. It helps me sleep better at night. Well, great. You're still you might potentially still be making the wrong data decision, but you sleeping at night is a heck of a lot more important than making the right data decision on that deal. And so you're right in doing that. But the CPA approach, the CPA side of me, the data side of me would tell you always make the best data decision.
Yeah.
And all of it comes back to math. All of it comes back to accounting and understanding what is your real cost of capital, what is your real IRR, and what is your real opportunity cost of doing something else with money. And so
Right.
that's how I view everything right
And
now.
I love your answer because 100%, and we do that, and then we just sit down. Is it like at the point in their life that we are right now? Is it worth it? And
Yeah, it might
that's
not
when then the more like the value decision coming in versus the pure data decision. I just wanted to throw that out there because it's not black and white.
No.
Black and white, and it depends on which age you are and where you are and what your needs are and what the assets are and things like that. When I was 37, and we just like we think we hit the $1 million level at my age, 33. Actually, no. Well, yeah, 33 or so, 31 or 33, 30, I believe 31. So 37, we were still in full pedal to the metal mode. And what happens if we lose anything or everything? We'll just rebuild it. We're young. We're good. We're going.
Yeah.
As you start going to the 50s, it's like it's interesting how that happens. Like, and I'm not the only guy that it says that. I talked to some other guys that, as we all kind of like in parallel getting a little older, it's like they're all saying the same. It's like, yeah, that changes over time. And now I understand why in like an area like Paradise Valley or Beverly Hills, people have free and clear multi-million-dollar houses because they're just saying like, yeah, I'm still making a really good return on all of that, but this house, it's just untouchable. It's done.
And listen, I think that I'll be in that boat someday, even a lot sooner than in my 50s, just for my wife and for my kids around my personal home and things. And I would tell you, even like to me, everything's data backed, but at the same time, there is the emotional feeling. And I'll give you a perfect example for me in our business. I don't believe DSCR loans with institutional investors, right? So these are your traditional non-bank loans that you're going to get a 30-year loan on an investment property. Historically, 10, 15, 20 years ago, it didn't really exist. Now it's everywhere. But the reality of it is those, number one, the interest rate's higher. Number two, you're paying more upfront costs, right? You're paying points. And so generally speaking, for us, it's $7,000 to $10,000 to $12,000 more every time we chose them over choosing a traditional five-year bank arm, which is essentially the rate resets every 5 years. And so you have more risk of what is the rate going to be in 5 years? What is the property value going to be in a shorter period of time? And so you have a little bit more risk doing that. And so it cost us more money, but we still decided to diversify. Or what I mean is essentially what you're saying, be more conservative in case something goes majorly wrong in the past. Even though the data tells us not to use the DSCR lender, it's more expensive. We still did it anyways to have some peace of mind around some of those loans that, look, we're set on this thing for 30 years. If something goes wrong, who cares? We don't got to worry about these, even though it's technically the wrong decision the data is telling us.
Yeah. There we go. There we are. Love that. Wonderful. Now, last thing, Accruity, what do you guys do there? Tell us about what's on your t-shirt here.
Yeah, Accruity is a full-service back office accounting firm, right? We from tax to bookkeeping to accounting to full-service reporting, delivery, managing custom spreadsheets for you, fractional CFO work if you need it. We're really out here to really help real estate entrepreneurs dial in their back office, right? We found, and I found, from my first few years and then traveling and going into masterminds, that there's a lot of folks out there that are incredibly talented at building businesses, selling, sales, right? But they're not the best at hiring. And so when you're not the best at hiring and running ops, you're certainly not the best at doing that in your own back office where you don't necessarily know financing really well. And I saw this niche in the marketplace where it was essentially, right, like, holy heck, we can help a lot of people do exactly what I did, scaling my real estate portfolio, just using numbers. And so that's what we set out to do. And we launched it about 3 years ago. We have a little over 100 clients now. 90% of those are in the real estate space. And the really cool thing is a lot of us come from public accounting backgrounds. And so we can do a lot of really cool things with our clients, whether that's just data entry, bookkeeping, as a lot of people call it, reconciliations, and really good financial reporting, to custom reporting, forecasting, investor deck reporting, portfolio understanding, DSCR calcs, right? But the really cool thing that we bring to the table that a lot of firms don't at this level and helping direct entrepreneurs is that we also can get them from cash to accrual basis accounting, right? We can get them exit ready if they want to be exit ready, because we come from public accounting, so we understand what that world looks like. Right? If you're interested in buying another company, we can do all of the due diligence for you so you can understand exactly how that company looks financially, right? So that you can focus on how can I scale a business? What do they look operationally? And so we can do all of those things for you, right? So we're really a one-stop full-service back office to really help real estate investors scale their organization.
Awesome. Very cool. And to give an endorsement on here, we recently hired you guys. And the very first thing we're doing is we're converting from cash to accrual accounting, which just gives us much better visibility, particularly in the coaching side of our business, where people come in and they enroll in coaching for 12 months. They paid over 10 months of that, or 10 to 12 months. And so it's like, how do you account for that? How do you you deliver services over the course of a year? Do you if somebody pays in full, do you recognize it all up front, or you spread it over time? How do you properly really determine how your company is doing? Because the way most people do it is like, hey, checkbook accounting, right? It's like, I got more money in my bank account at the end of the month this month than last month. Yay, I'm making money. And that's just not the reflection of reality. So we are converting that right now with your help. We should be done in the next 2-3 days. And we're excited about that. And And so yeah, recruity.com, all right? Just
Yeah,
go reach out to
recruity.com
them.
for sure. Yeah, feel free to reach out to me on socials as well. I'm all over the social
Yeah.
media world. Casey Quinn, Casey Ryan Quinn, recruity.com. However, man, we're happy to help anybody, any of your listeners. I really appreciate the endorsement. We love helping you. It's been a lot of fun for us, particularly projects like yours. They're fun projects because we love working with people that know what they're talking about. I was going to say maybe we should get you selling for us a little bit because you understand what accrual accounting is and why it's so important. Where there's a good bit of entrepreneurs out there that just don't quite understand that yet, right? And so part of the game is education. We're focused on educating more folks that look. At the end of the day, you've got to understand your financial picture a lot more than just what is sitting in your bank account because you've got to be able to make decisions out into the future. And if you don't understand your accounting, it's really difficult to make decisions in the future. Who should I hire? What marketing spend should I have? Right? All of the things. The moment you're working in the past, it's too late. And so you
The
got to use
problem, I
the
think
past
we,
to make
yeah,
decisions in the
I
future.
think that's subject for another podcast that we'll
Yeah.
have you and Jeff on there, your CFO, and we'll talk about that. But yeah, I mean, the point is like the reason I understand to some degree, at least, what we're doing here is that I do have a business degree. I went to business school in Germany and in the US. Essentially, I have two MBAs, to both my like and. But that's 25 years ago, and if you don't use that stuff on a daily basis, like you guys, you worked in public accounting. Became a software consultant afterwards, so like I didn't use any of that stuff forever.
Yeah.
The benefit of that, though, when people say like college has no use, I disagree to some degree. The reason I want my daughter to go to college is, and I ideally want her to get a business degree, is because understanding the fundamentals of business is useful for the rest of your life. Because in anything you do, like in the business world, if you become an entrepreneur, you understand that. Now, I don't understand the first thing in detail anymore about all these things, but that's when you bring experts in. But at least we now can have a conversation on a level that you know that I understand the concepts you're talking about, but I couldn't do any of that stuff that you guys are doing because I've never learned the details of it.
Yeah, but that's
Accounting,
not. The really cool thing is it's not your job. Like your job is to run a
right,
company. And your
right.
job is to make sure you're getting the information you need to run the company. And that's what
Right.
you're good at, right? That's what really good entrepreneurs are really good at is saying, look, I don't know how to do these things, but I know how to use this information to run the company the
Yeah.
right way. And I think that's the more important piece to it. The bigger key
Correct.
is
Yeah.
as an
And I understand
entrepreneur,
the concepts behind it.
yeah, you've got to understand the concepts and then how to use the data that the accounting is telling you, right? It goes all the way back to Warren Buffett, right? He said accounting is the language of business.
Yeah,
And
and it
I
is. It is.
wholeheartedly believe that.
Yeah, absolutely. Last thing, how can we help you?
Give us a call if you need us. No, I mean, I think for me, right, that's really what it is. We're here to help, right? We've had success. We're really happy with where we're going. We found incredible joy in being able to help entrepreneurs that struggle in the back office, in the finance and accounting department. And so, we literally just had a meeting yesterday. We were talking about the joys we get when we see our customers, really understand for the first time the power of accounting and how it's not a cost. It is a revenue driver. It is a business driver. It is a decision maker for you and your organization. And when people kind of flip the switch and get it, that's what drives us. That's what motivates us. That's what's really cool. And oh, by the way, we make money off it, right? Like, let's just be real. We're all in business to make
Of course.
money. And so, that's what I would say, right? Reach out to us. We'd love to have a conversation and really kind of get accounting to the forefront of decision making for everybody that's running small businesses because, I believe the failure rates of entrepreneurs would be significantly less if they understood finances and accounting inside the organization significantly earlier on than they do for the most part.
I do agree with that. Absolutely. All right. With that said, so the link is accruity.com, which is double C, right? ACCRUITY.com. Is that the link or is there a different link you want to send people?
Yeah, that's good. Yeah.
Okay. So go check it out. They're very reasonable. They help with all kinds of levels of companies. Obviously, you don't teach BRRRR. That was more like this is how you made the money. So we really did a double podcast here talking about BRRRR at the end, talking some accounting things. But I love the fact.
Well, listen, I encourage even through Accruity and everything else that if you're in real estate investment and you're listening to this today, figure out a way in the next 6 months to keep one more property if you're wholesaling or fix and flipping, or if you're doing something in the trade, find a way to buy your first real estate deal and keep it. Because
Yeah.
nobody I've ever met has ever regretted keeping a piece of property, right? Everybody regrets selling them. So find a way to do that and you'll be better off.
I agree. Perfect ending words. With that said, thank you very much, Casey. And that concludes our session. As always, give us that 5-star review and share it with your friends if you enjoyed this episode. And with that said, see you in the next show. Bye-bye.